Good evening. Welcome to our year-end investor update. I am so excited to be here with you this evening, and I want to thank you for spending your part of your evening with me. It's really appreciated. My partner Frank is on with us as well, and we had a great amount of information in a very short period of time. Should take about 20 minutes to share with you. There's so much going on right now in our world. This information that we're going to bring to you is going to be extremely informative and very, very helpful. Okay, so we thank you again for sharing part of your evening with us. So let's get started. Today's agenda is straightforward. First, we will share a brief investor update, and then we will discuss some ideas and strategies you can consider. Before we get to the presentation, we'd like to take a minute to remind you to stay safe and please try to stay positive. It's tough out there, but let's try to stay positive. We are still experiencing challenging and unprecedented times, but as we like to remind all clients, please make your health a priority. It is always important to start by reviewing that there are 5 key areas of financial planning: preservation planning, retirement planning, tax planning, estate planning, and investment planning. Even though today's presentation is primarily about the equity markets, as a comprehensive wealth management firm, we try to always consider the impact of any recommendation we make on not just one, but all of these areas for our clients. That's kind of what makes us different. The third quarter of 2020 reminded us, many investors, that uncertainty and confusion is not a plan. The first 3 quarters of 2020 were very confusing for investors. In mid-February, the S&P 500 made new all-time highs. Then, because of COVID-19, in March, the S&P fell from its February 52-week high to a 52-week low. Although after March, the economy remained confusing and at best, started in late March, equity markets rebounded to make new highs by early September. Then in September, equity markets shifted slightly lower, but for the year, as of early October, they remained slightly up. Although equity markets had moved significantly higher after the third quarter of 2020, investors faced interest rates and bond yields remaining ultra low, unemployment improvement, but still at disturbing levels, home signings recording a record high, personal income recording a decline, and disease experts warning about a potential flu season progression of the COVID-19 outbreak. The Federal Reserve officials confirmed in September that they would be holding interest rates near zero. They also shared that they would stay there for at least 3 years, which effectively means that the Fed will keep their key rate at a near 0% till 2023. With interest rates at record lows, income-seeking investors looking for reasonable yields could be very disappointed. The low interest rate environment has been described as a bonus for borrowers and a nightmare for income-oriented investors. Think about what the banks are paying today, and that's a pretty good indication of where interest rates are. Think of why mortgages, 30-year mortgages, are so low right now, and houses are basically falling off the shelves. Very interesting what's happening in our economy today. So what is the potential true cost of safer investment? According to Barron's, the average bank money market rates on October 5th, 2020 was 0.10, and the average 12-month CD rate was 0.27%. That's counterproductive, folks. That's not smart financial planning, because there's no growth whatsoever. So we have to look at strategies. For many investors, these low rates might not help them reach their goals. Therefore, equities could be a part of your diversified portfolio. Makes sense. Although the equity markets have had some strong years since 2016, here's an interesting way to look at equity returns. Is it a stock market or a market of stocks? What do we mean? In September 2020, Goldman Sachs noted that although there were strong returns in the S&P during this almost 5-year period, there were 5 stocks known as FANG, an abbreviation for Facebook, Amazon, Apple, Microsoft, and Google, turned in a 244% return, while the other 495 companies, the S&P, had a combined return of 41%. That is incredible. That is incredible. Well, those 5 companies are large and well-respected companies. Several of them do not offer a dividend, and they may not be the most appropriate for income-seeking investors, conservative investors, or retired investors. Let's think about that. So where are equity markets headed? Investors need to prepare for volatility. Many investors this quarter enjoyed a nice rise in equity prices, and some analysts caution that based on historical numbers, like price earnings, the case can be made that equities are highly overvalued and overpriced. Others debate that with ultra-low interest rates and high levels of liquidity from the Federal Reserve, equities are still attractive. Jeremy Siegel, the Wharton professor who is credited for predicting that the Dow Jones would cross 20,000 in 2015, explained to CNBC in an interview on September 28th why he believes that the stock market is looking forward to a really good run next year. Now, regardless of who takes the White House, Siegel explained that the tremendous burst of liquidity from the Federal Reserve and Congress will continue to provide a huge tailwind for stocks. Siegel also added, I think that uncertainty is going to continue to weigh on the stock markets. Some other strategies are cautioning against equities. Also, as a quick reminder, the fall season has historically produced some of the more volatile periods for equities in general. While we are not being political at all, we still need to remind you that the markets do not like uncertainty. Wall Street doesn't like these kind of things, folks. And today's political environment is certainly uncertain. The presidential election and important congressional races remain as one of the more talked about subjects in the world today. Our goal is to focus on facts and be watchful of how the political landscape will potentially affect your investments. The political results of the upcoming quarter could affect an investor's outlook, and therefore this is a topic for us to monitor. Is a future market decline an entry point for new and additional funds or an exit point? As this chart shares, since 1987, there have been several large declines in the S&P. It is also sharing that 12 months later, the equity market had moved to a better place. While past performance obviously is not considered an indication of future performance, this information confirms that panicking and selling after the decline may not be the best idea. This is one of the things that we try to avoid or help our clients avoid is behavioral drift. Using your emotions to make decisions can be a trap that you want to try to avoid at all costs. Frank and I are doing this for a very, very long time, and we've seen what happens when people panic, and we've also seen what happens when people are disciplined and stay the course and remain on track. And always remember, folks, like we always talk about during the reviews, the best way to get back on track is to stay on track. How should an investor move forward? One of our responsibilities is to look at all situations and guide our clients with ideas. Our main goal is for us to consistently search for opportunities. Let's quickly review some of them. A year-end review to see if your risk tolerance has shifted is always important. Always revisiting to see if your time horizons have changed is always wise. Let's think about your taxes for a minute. We all know that once December 31st comes, the chapter is closed for tax season, right? So wouldn't it make sense to plan ahead? Of course, because we don't want your experience when you have your taxes done to be like going to the dentist. So we want to be proactive. We want to plan ahead. We want to strategize. That's why we continue our reviews. And whether we do those reviews in person or we do them virtually, they're a critical part of what we do, and they must continue. They must continue. So important. Maintaining a properly designed and well-diversified portfolio is important. Everybody remembers what the 3 rules of investing are. Diversify, diversify, diversify. Rebalancing is defined as the process of buying and selling portions of your portfolio in order to set the weight of each asset class back to its original state. We can look at your portfolio and consider any rebalancing that may need to be performed. These are the things that we do behind the scenes. Know your tax bracket and try to be tax efficient. Lord knows we all see all these different tax laws just in the last few years. Now we have a new administration, there'll be more. In a couple of years from now, there'll be even more. So our job is to make sure that we interpret these laws and we study them, and we make sure that we use the ones that are going to benefit you. So again, you could be in a position to make a more informed decision overall. So for illustrative purposes, we have grouped tax brackets into 3 major categories. While the goal is to always be tax efficient, it is easier for those who are in the 10% or 12% tax bracket to be efficient. That makes sense. For those who are in the 22 or the 24% tax bracket, this group of taxpayers are the ones we like to refer as needing to be tax aware. And for those in the highest, to 32, 35, and 37 brackets, they are what we refer to as most tax sensitive. All investors, regardless of your tax bracket, should have a goal of considering and trying to minimize taxes when possible. Everybody knows that Metropolitan Capital Tax and Wealth Management, our motto is minimize your tax and maximize your wealth. Remember, at the end of the day, folks, it's not what you earn, it's what you keep. Very important. If you have not already seen our year-end tax reports, ask us about our year-end checklist. We'll be happy to go over that with you during your reviews. Also, looking at possible Roth IRA conversion is something to think about. Many of our clients come to us with these questions, and we feel that this can be a strategy that could be effective. We're going to bring that to your attention. Converting to Roth IRAs can bring benefits, which include the following. A Roth IRA conversion lowers overall taxable income long term. You benefit from tax-free compounding. Roth IRAs have no RMDs at the age of 72. I just want to stop there for a minute. Under the Secure Act, folks, talk about tax law changes, which was passed in 2019, the end of the year. Remember the old days when required minimum distributions had to be taken at age 70 and a half? Well, now that has been extended to age 72. But with Roth IRAs, there is no required minimum distribution, which means obviously you're not required to take money out. There are tax-free withdrawals for beneficiaries. So one of the reasons why someone would convert an IRA to a Roth IRA is to leave their family members tax-free distributions. Okay, that's very, very important strategy because most people do not use the money in their IRA. Statistically, 90% of people do not use the money in their IRAs because they have good income, because they have other investments and so forth. Okay, so this could be a strategy that we can talk about during your next review. Legendary investor Warren Buffett says that whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. Legendary portfolio manager Peter Lynch shares that people who succeed in the stock market also accept periodic losses, setbacks, and unexpected occurrences. Market drops, they don't get scared. and they don't scare themselves out of the game. These are good quotes for investors to hear. Maybe that's why both of these two gentlemen are billionaires, because they walk their own talk. Okay, and if you think about that, it's very, very important not to panic, because why? Volatility is normal. Corrections, trade-offs, sell-offs, even recessions, they're normal occurrences, and they're part of the investment experience. You can't have one without the other, right? We know this. We're smart enough to know that we've been investing for a long time. We have experience. We know that these things are common. Remember, we can't control how we think. We can only control how we react. So again, we try to avoid reacting on emotion. That usually gets people into trouble. Thinking long-term is still the way to look at equity investments. Typically, the most successful investors think and act for long-term. There's really no such thing as short-term investing, folks. If you want short-term investing, then we're going to go to Atlantic City. We're going to go to Las Vegas and, play the slots or play whatever your game is. But this is not what we're talking about. We're talking about protecting your legacy. We're talking about protecting your income. We're talking about making sure that you never have to worry about running out of money. And we have to incorporate all of these concepts together. So there's a synergy between taxes and investing in estate planning. Okay, it's near impossible to predict exactly where the markets are going to move, but we can certainly prepare for that, right? We can be strategic and be proactive and be more hands-on, as opposed to being reactive and passive. That's why these reviews are critical. As a recap, what are some key takeaways for investors? The first 3 quarters of 2020 have been a wild ride for equity investors. For those of you who like roller coasters, you've definitely had your share of a wild ride this year, no question. Volatility has reemerged, and investors need to proceed with caution. Think about driving your car. When you get in your car, we got the radio on, and whatever your music, whatever your flavor is, put your seatbelt in, and you lock yourself in and you're driving down the road, but we still have to check our mirrors, don't we? We have to see what's going on around us. Well, the same thing applies to investing. We have to be vigilant, but we have to be cautious also, but optimistic, right? But we have to be aware. We have to keep a watchful eye. We have to be mindful, because markets move very, very quickly when you least expect it, okay? And it's important to, again, stay focused and stay positive. That's why you have us. So your health is our top priority. None of this stuff matters if we don't have our health. We all agree with that. And as always, focus on your personal goals. And of course, call us with any concerns that you may have. We are here. The team is standing by. That's what we're here for. So what can you expect from us? You can always call us if you did not see our year-end tax report. You can expect regular communication, more frequent discussions, and you can expect that we are continuously reviewing economic, tax, estate, and investment issues for our clients. So again, I want to thank you for your time today. I promised I would keep it short and sweet. If you have any questions, you can type them right in. I'll be happy to answer those. Remember, your health and well-being is our highest priority. So we appreciate the opportunity to assist you with your financial needs. We would like to help others. In fact, some of our best clients were referred to us by existing clients. We would be honored if you can share some names, friends, to add to our mailing list so that they can benefit from our information. Please feel comfortable letting us know the names of anyone who you feel could benefit from this information. And thank you for watching our update. Good night, and God bless.